Hey everyone, welcome back to Corporate Decoder. Today, XChange TEC Incorporated just filed its Form 6K, and I'm seeing a lot of big changes that could impact its future. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report shows a company dealing with significant financial challenges and making some big strategic moves to try and get back on track. So, XChange TEC Incorporated has released its Form 6K report. This is essentially a report for foreign private issuers that need to share important information with the public, because these companies are based outside the United States, they have different reporting rules. Let's dive into how the company is doing. They are in the insurance agency and technology business, mainly in China. They acquired Alpha Mind Technology Limited back in December of 2023, which seems to be a big part of their current operations. They also acquired a company called Topone Consultant Limited in Hong Kong in March of 2025. Now let's look at the numbers for the first 6 months of 2025 and 2026. Revenues went up from about 175.7 million RMB to around 197.8 million RMB. That is a decent increase, about 12.6%. This actually looks positive on the surface, showing that they are bringing in more money from their insurance agency services. However, when you look at the costs, things get a bit more complicated. The cost of revenues also increased, but almost in line with revenues, going from 171.4 million RMB to 192.2 million RMB. This means their gross profit margin, which is the money left after covering the direct costs of selling their services, stayed pretty thin. It edged up slightly from 2.4% to 2.8%. That is a very narrow margin, meaning for every dollar they make, only a few cents are left to cover other expenses. The real story here is the drop in operating costs. Selling and marketing expenses went down from 6.1 million RMB to 5.5 million RMB. General and administrative expenses also decreased from 11.9 million RMB to 8.5 million RMB. This suggests the company is trying to cut down on its spending, which is understandable given their financial situation. But here is a massive red flag. In the 6 months ending the 31st of March 2025, they reported a goodwill impairment loss of a staggering 644.9 million RMB. Goodwill is basically an intangible asset that a company records when it buys another company for more than the fair value of its identifiable net assets. Taking a huge hit like this means that the value they originally placed on Alpha Mind Technology Limited has been drastically reduced. This is a non-cash charge, meaning it does not involve actual money leaving the company right now, but it reflects a big loss in perceived value from that acquisition. For the same period in 2026, there was no goodwill impairment loss, which is good, but it followed that massive write-down. Because of that huge impairment charge in 2025, their operating loss was a monstrous 658.6 million RMB. However, without that big write-down in 2026, the operating loss for the same period in 2026 was much smaller, at 8.4 million RMB. This massive difference really highlights the impact of that goodwill impairment. Following these trends, the loss before income taxes also shows a dramatic decrease. In 2025, it was 677.7 million RMB, and in 2026, it dropped to 17.9 million RMB. This huge reduction is primarily due to the absence of that goodwill impairment in the later period. And finally, the bottom line, the net loss. It mirrors the trend in operating results, shrinking from 677.7 million RMB in 2025 to 17.9 million RMB in 2026. While this looks like a significant improvement, it is mostly because that one big accounting loss didn't happen again. Now let's look at the company's financial health on its balance sheet. As of the 30th of September 2025, total assets were about 69.4 million RMB. By the 31st of March 2026, they decreased slightly to 65.1 million RMB. On the other side of the balance sheet, liabilities are a huge concern. Total liabilities were a massive 949.5 million RMB in September 2025, and still very high at 936.5 million RMB in March 2026. This means the company owes a lot more than it owns, and this leads to a substantial shareholders deficit. This means the value of the company's assets is less than the value of its liabilities. In September 2025, this deficit was 880.1 million RMB. By March 2026, it had slightly improved to 871.4 million RMB, but it is still a very large negative number, indicating the company is in a precarious financial state. When we look at cash flow, we see a pattern of the company using more cash than it brings in. For the 6 months ending the 31st of March 2026, net cash used in operating activities was 8.5 million RMB. This means the company's day-to-day business operations are burning cash. Investing activities also used cash, with 414,000 RMB spent. Financing activities did bring in some cash, about 1.6 million RMB, but it wasn't enough to cover the operating and investing expenses. This brings us to a critical point, the going concern note. This is where the company itself acknowledges there is substantial doubt about its ability to continue operating. They mention persistent losses, negative operating cash flows, and current liabilities exceeding current assets. This is a serious warning. They are trying to raise new funds through equity offerings and have plans to meet their obligations, but there is no guarantee these plans will succeed. Historically, companies with going concern warnings, especially smaller ones, often face significant challenges. Think about companies like Bed Bath & Beyond or Rite Aid, which struggled for years before ultimately filing for bankruptcy. The problem is that if they can't secure the necessary funding, they might have to cut back on spending or worse, be unable to operate at all. Looking at their financials, this isn't a surprise. They have a huge shareholders deficit, meaning they owe much more than they own. The company is heavily reliant on financing. They have promissory notes from the AlphaMind acquisition that need to be paid. They've been trying to manage this through debt and equity. A significant development is the 15th of April 2026 Securities Purchase Agreement with VG Master Fund SPC. This agreement gives X.H.G TEC the right to sell up to $100 million of its Class A ordinary shares represented by American Depository Shares or ADSs to VG. However, and this is important, the company is not obligated to sell any shares. It is their option. This means they could potentially raise significant capital, but they also might not, leaving them short on funds. As of the 31st of March 2026, they had about 4.4 million RMB in cash and cash equivalents, and another 5 million RMB in restricted cash. That is a total of about 9.4 million RMB, which is roughly 1.4 million US dollars. This is a very small amount of readily available cash for a company facing such large liabilities and operational needs. Let's circle back to that AlphaMind acquisition. It happened on the 28th of December 2023 with a total consideration of $180 million, paid via promissory notes. They've been extending the maturity dates on these notes, which just kicks the can down the road. Then, on the 6th of June 2024, they issued shares to Burgeon Capital instead of paying cash for a part of the debt. More recently, in June 2025, they extended the maturity date of the remaining notes again, this time to the 31st of December 2026. This ongoing deferral of payments is a clear sign of cash flow problems. The notes payable alone stood at over 647 million RMB as of the 31st of March 2026. The acquisition of Topone Consultants Limited in March 2025 was much smaller, costing about 1.1 million RMB. It did add some intangible assets like an insurance intermediary license, but it is a minor transaction compared to the AlphaMind deal. The notes payable are a huge part of their liabilities, largely stemming from that AlphaMind acquisition. As of the 31st of March 2026, these notes payable were 647.4 million RMB. They've been trying to manage these by extending deadlines and converting some debt to equity, but the sheer size of this liability is a major challenge. It is interesting to note their share incentive plans. They had the 2022, 2024, and 2025 equity incentive plans. However, for the periods ending the 31st of March 2025 and 2026, no share-based compensation costs were recognized. This might indicate that awards were granted but not yet vested, or that the plans haven't been actively used for compensation yet. It is something to keep an eye on. Now, let's talk about earnings per share for both the 6 months ended the 31st of March 2025 and 2026, the net loss per share was a tiny fraction of a cent, essentially 0 RMB. This is because the company has so many shares outstanding, and the net loss, while large in absolute terms, is divided by an enormous number of shares. For example, the weighted average number of shares increased from about 2.46 billion in 2025 to over 123 billion in 2026. This huge increase is due to stock consolidations and new share issuances, which significantly dilutes the value of each existing share. Going back to the going concern issue, this is the most critical takeaway. The company is essentially saying they might not be able to stay in business without significant new funding. The plans they have, like the shelf registration statement on Form F-3, which allows them to offer up to $300 million in securities, and the agreement with VG Master Fund, are their attempts to secure this funding. However, there is no guarantee they will succeed, and if they don't, the consequences could be severe. This situation is similar to what we've seen with other struggling companies that eventually fail to recover. The market usually reacts very negatively to such disclosures. Looking at what happened after the 31st of March 2026, the company's shelf registration statement allowing them to potentially raise up to $300 million was declared effective by the SEC on the 1st of April 2026. Then on the 15th of April 2026, they entered into that agreement with VG Master Fund to potentially sell up to $100 million in ADSs. This shows they are actively trying to raise capital. The timing and extent of these sales are entirely up to XChange Tech, and they are not obligated to sell anything. This flexibility gives them an option, but it doesn't guarantee the funding. The report lists a securities purchase agreement dated the 15th of April 2026 with VG Master Fund SPC. This is the agreement I just mentioned, outlining the terms for potentially selling up to $100 million worth of shares. So what is the big picture here? XChange Tech is essentially in a fight for survival. They've got a decent revenue stream, but it is paper thin on profit margins, and they are burdened by massive liabilities, mostly from a large acquisition. The Goodwill impairment was a huge accounting hit, but even without it, the company is still running at a loss and burning cash. Their future hinges entirely on their ability to secure significant new funding through these equity offerings. If they can't pull it off, the going concern warning could become a reality. The risk I am watching is whether they can actually execute their fundraising plans and avoid a catastrophic financial collapse. The company's success is dependent on securing substantial new financing, and that is a very high-risk endeavor for a company in their current financial state. If you found this deep dive into XChange Tech's filing helpful and want to see more analyses like this, be sure to subscribe and hit that notification bell. The research tools that help me break down these filings are linked in the description below, and they support the channel. That is my take. Stay decoded, and please like, comment, and subscribe if you found this video valuable. You can also join our community Discord, link in the description.